Thanks for tuning in to Benoit Capital's October 2025 Market Navigator Update. I'm Michael Cochran, and I'll be walking you through the key themes impacting the markets and economy this month. As always, please stay tuned for an important disclosure at the end. Market fluctuations are an inherent aspect of investing, and 2025 has demonstrated this reality. Although downturns, like the tariff-induced decline earlier in the spring, can be unsettling, they often present chances to purchase assets at better prices. Conversely, when markets rebound and hit new peaks, some investors may experience some anxiety despite solid fundamentals. In either situation, maintaining portfolios designed to endure all market cycle phases while keeping long-term financial objectives in focus becomes critically important. Entering the year's final quarter, investors confront contradictory indicators. The S&P 500 achieved fresh record highs during the third quarter, buoyed by robust corporate profits and excitement surrounding artificial intelligence. Simultaneously, we've seen overseas markets participating nicely, along with bonds as well. On the economic front, the labor market has experienced deterioration since early summer, sparking worries about economic fundamentals and consumer financial stability. Nevertheless, GDP expansion has remained solid, and inflation has been relatively contained. With markets hitting all-time highs, much of the discussion centers on whether stocks are becoming too expensive. However, if you exclude the largest names, such as the Magnificent Seven, valuations aren't as rich. For companies that still appear pricey, elevated ratios don't necessarily mean overvaluation. They may reflect a shift in market structure. Unlike past decades dominated by capital-intensive companies, today's S&P 500 is driven by sectors with scalable models, stronger margins, and more resilient earnings. In this context, higher multiples may represent a premium investors assign to quality and durability rather than unjustifiable pricing. I'd encourage you to visit our website and read a recent blog post on this. Over the past year, the Federal Reserve has taken center stage, with last month's cut being the first in a year. Unlike past cycles triggered by recessions, today's cut reflects an effort to normalize policy following the sharp tightening that began in 2022. Even as the economy continues to expand and markets trade at record highs. The key driver has been a cooling labor market, where unemployment remains relatively low at 4.3%, but jobs growth has slowed, with a weaker report in August. Consequently, the Fed is reducing rates because, according to the latest FOMC statement, it, quote, judges that downside risks to employment have risen. For investors, rate cuts generally support both equities and bonds when economic strength persists. Quickly shifting to the effects of policy on the economy. We saw sharp swings from tariff announcements earlier in 2025, but measures of economic policy uncertainty have improved, and various volatility measures are now below average. Still, calm can shift quickly, as seen in recent years, with volatility driven by inflation, trade wars, Fed policy, recessions, and geopolitical events. While uncertainty often feels uncomfortable, it's a permanent feature of the market and a key driver of long-term results, creating opportunities for those disciplined investors to position portfolios for the future. At Benoit Capital, we're always here when you need us. For our existing clients, that means being just a call away to answer questions and keep your plan on track. For those we haven't yet had the opportunity to work with, we'd welcome the chance to sit down, learn your story, and explore how our team can help you pursue your goals with clarity and confidence.